It is Monday, February 16th, 2026. And look, if you've been keeping an eye on the Jamaican housing market, you know the story. It's just this constant loop of rising costs, not enough houses, and the feeling that getting onto the property ladder is, well, it's almost impossible now.
That barrier to entry has become a fortress wall, really.
Exactly. Yeah. But today, we're looking at a proposal that claims to maybe, just maybe, install a back door in that wall.
Or at least give you the part so you can hang the door yourself.
Right. We are digging into this really fascinating idea from a Kingston-based developer. They've recently rebranded as Different Capital. And they're floating a concept that is, it's pretty much unheard of in our residential market.
A shell apartment.
The shell apartment.
Yeah.
And just to be clear, we're not talking about a fixer-upper, buying an old place and renovating it.
No, not at all. This is brand new construction, sold deliberately unfinished. It's a model that Different Capital is hoping will tackle that affordability crisis, but it really opens up a whole Pandora's box of questions. Logistical, financial, even cultural.
It does. When I first read about this, my immediate thought was, okay, so this is like IKEA for houses. You build part of it yourself, so it's cheaper. But the more I dug into it, the more I realized this is not just about saving a few dollars on tiles. This is a fundamental change in the relationship between the buyer and the developer.
It really is.
So let's start with the basics. When they say shell, what are we actually buying? What do you get?
You're buying the envelope of the building, the structural integrity. So according to their specs, you get the exterior walls, the windows, the external doors, and the rough-ins.
Rough-ins being the basic pipes and wires in the walls.
Exactly. The foundational plumbing and electrical infrastructure. But that's it.
So to be really clear, if I walk into my brand new apartment on day one, am I standing on concrete?
You are standing on raw, bare concrete. There are no floor finishes, no internal partitions.
Wait, no walls?
No internal walls. So if you bought a one-bedroom, what you really have is a big open space where a bedroom could go. No kitchen cabinets, no bathroom fixtures, no paint, nothing.
It's like buying a ar, but all you get is the chassis and the engine in a crate. You save a lot on the sticker price, but you definitely can't drive it home.
That's a great analogy. But, with a car, you could probably bolt the seats in over a weekend. This is a lot more complex.
I bet.
The deputy CEO of Different Capital pointed out that those internal finishes, they account for 30 to 40% of the total construction cost.
30 to 40%. That number just jumped off the page at me. Is that normal? It seems incredibly high.
It's actually pretty standard, especially when you think about the developer's whole business model. And this is where we really need to get into the economics of it, because it's not just about the cost of the countertop.
Okay, walk me through that, because my first thought was just simple. The developer doesn't buy the tiles, so I don't pay for the tiles. But you're saying it's more complicated.
It's much more. Think about a project's timeline. The heavy structural work, pouring concrete, putting up steel, that part actually moves pretty fast. It's the finishing phase where everything slows right down.
Right. All the different contractors for tiling, painting, cabinets.
Exactly. You're coordinating all those teams, dealing with snag lists, punch lists. That phase can drag on for months and months.
And all that time, the developer is sitting on a huge construction loan, paying interest on it every single day.
Precisely. By selling you a shell, Different Capital is basically outsourcing the risk and the time of that finishing phase to you, the buyer. They get to exit the project months earlier.
Which means they can get their capital back and move on to the next project way faster.
And that dramatically boosts their internal rate of return, their IRR. So they're essentially trading a bit of margin on one unit for sheer velocity. They can build and sell more units in the same period.
And the deal, for me, the buyer, is that I'm not just saving the cost of the finishes, I'm also saving the developer's markup on those finishes.
That's the key. Because a developer never just passes on the cost. If they pay $5 for a tile, they're selling it to you for $7 or $8 to cover their overhead, their risk, their profit.
But in this model, I can go find that tile myself. Or, get my cousin who's in the business to find it for me.
You got it. And that brings us to who this is actually for. This is not for someone looking for a turnkey rental investment.
No. This feels like it's aimed squarely at the DIY savvy crowd.
Yeah.
Or maybe not even DIY, but the I can manage a contractor crowd.
It's for the resourceful. The idea is to lower that upfront purchase price to get median income households in the door. The theory is that while your total cost to finish it might end up being pretty similar.
Because you don't have the developer's bulk buying power.
Right. But the upfront mortgage you need is significantly lower.
Okay, but that's a huge assumption. It assumes the bank's going to play ball. And I have to say, I'm skeptical. Jamaican banks are notoriously conservative.
Hmm.
If I walk into a bank and say, "Hi, I'd like a mortgage for a concrete box with no toilet," what's their reaction going to be? Are they really going to lend on that?
That is the multi-million-dollar question, isn't it? A traditional mortgage is based on a certificate of practical completion and a valuation that says the property is habitable. A shell, by its very definition, is not.
So you can't get a regular 30-year mortgage on this.
Not easily. No, the banks would probably need to treat it more like a construction loan. You might get a product where they lend you the money for the shell itself, but then you need a totally separate loan for all the finishing work.
Which sort of complicates the whole affordability argument, doesn't it? Construction loans often have higher interest rates, or they require those staged inspections.
Right. The bank isn't just going to write you a check for $3 million to finish your apartment. They will release the funds in tranches.
So, show us the plumbing is done. Okay, here's some more money. Show us the tiling is finished.
Here's the next check.
Yes. That sounds like a full-time job.
Yeah.
You're not just a homeowner anymore. You're a project manager who has to report to a loan officer every week.
And that's the real friction point. The whole loan-to-value calculation gets messy because the value is hypothetical until the work is done. It's a risk for the lender. I'm sure different capital is having some very intense conversations with banks right now to try and create some kind of new hybrid loan product.
Because without the bank's buy-in, this whole concept is dead in the water.
Completely.
Okay, so let's shift to the physical reality. Let's say I get the loan, I buy my shell, I'm excited, but I'm moving into a building where 50 other people are doing the exact same thing.
Then welcome to what we could call the construction site problem.
I was thinking about this. In a normal apartment building, you move in, maybe your neighbor drills a hole to hang a TV, and it's annoying for an hour.
Right.
In a shell building, you could have dozens of units all undergoing major construction at the same time. But not even at the same time.
Asynchronously, that's the real issue. You might have the cash and the drive to finish your unit in 6 months, but your neighbor might not start for a year or 2 years. You could be living next to a jackhammer and concrete dust for years on end.
And what about the common areas? Who's paying for the elevator that's being destroyed by contractors hauling cement and drywall up and down all day, every day?
That is a huge concern. Normally, all that heavy work is done before the elevators are even commissioned for residents. Here, the wear and tear on the building's core infrastructure starts on day one. Your strata fees might have to be sky high just to cover basic repairs from the get-go.
It also seems like a regulatory nightmare. You need a certificate of occupancy to legally live in a new building. How does that work here? Can the parish council sign off on a building that's essentially 100% uninhabitable shells?
Well, the building itself might get a certificate for its structure, but the individual units won't be certified until the owner completes them to a certain standard. This creates a really weird legal gray area.
How so?
Well, let's say your Unit 402 is perfectly finished, all wiring up to code. But in Unit 403, the owner ran out of money halfway through, and there are exposed live wires in the walls. Is the building truly safe?
That's a terrifying thought. Fire safety in a high-rise where half the walls might be open.
It suggests the Strata Corporation, the building's management body, would need to have almost draconian powers. They'd have to approve every contractor, inspect every major installation. It's not really do whatever you want.
It's do what you want as long as you follow these 1,000 rules and don't burn us all down.
Which kind of undermines the whole freedom and personalization argument a bit, doesn't it?
It does. But let's zoom out a bit. This isn't the first time this has been tried somewhere in the world. The source material mentioned the China model.
Yes, in China, the rough cast or Mao Pai apartment became standard. It started for cost reasons, much like the proposal here, but it actually evolved into a cultural preference.
A preference? Why?
A deep-seated distrust of developer quality, actually. Buyers assumed the wiring and plumbing were cheap and would rip it all out anyway to install their own. They wanted the shell so they could control the quality themselves.
So it was driven by a lack of trust.
Partly trust, and partly a real desire for deep personalization. But the cautionary tale from China is the phenomenon of rotten-tail buildings projects, where either the developer or the buyers ran out of money and you're just left with these ghost towers of concrete skeletons.
That's the ultimate risk, right? If you lower the barrier to entry too much, do you attract buyers who are just too financially fragile for this? Someone who can barely afford the shell gets hit by one emergency and construction just stops.
And now you have a building that's half-finished homes and half concrete caves. And that absolutely destroys the property value for everyone, even for the people who did manage to finish their units. Your asset is only as strong as the building it sits in.
So different capital isn't just selling a product. They're trying to import a whole new cultural behavior.
They are. But, and this is where Dean Jones from Jamaica Homes had a really interesting take, maybe it's not importing a new behavior at all. Maybe it's just formalizing a very old one.
What do you mean by that?
Jones's insight was that the turnkey, fully finished apartment is actually the historical anomaly in Jamaica.
Right. I think about how my own grandparents built their house in the country. They didn't get a 30-year mortgage for a finished 4-bedroom house. They bought a piece of land, they built 2 rooms, and they moved in.
The incremental build, that's it. You build what you can afford when you can afford it. You add a veranda when you have a good crop. You add a second floor when the kids get older. That is the traditional indigenous way Jamaicans have built wealth.
And the modern banking system basically killed that model.
Yeah.
It said, no, you must borrow all the money up front for a finished product that you might not even fully need yet.
Correct. So what different capital is proposing, in a way, is applying that rural incremental mindset to urban vertical living. They're saying, here are your plot of land in the sky, build it out at your own pace.
That's a very romantic way of looking at it, and I want to believe it. But the critical difference is that when my grandfather paused construction, he wasn't sharing a wall with a neighbor who was trying to get some sleep.
That is the crucial difference. Incremental building works great on a quarter-acre lot. It is exceptionally difficult and creates immense social friction in a high-density apartment building.
So we've got this incredible tension. On one hand, a desperate need for affordability and a deep cultural history of sweat equity.
And on the other, the very rigid realities of modern banking, insurance, building codes, and, just having to live peacefully with your neighbors.
Not to mention the sheer skill required. We all watch home renovation shows and think we can manage a project. But a full fit-out, plumbing, electrical drywall, cabinetry, what you're holding down a 9 to 5.
It's a recipe for burnout and disaster for a lot of people. It's the Pinterest versus reality gap.
Totally. You imagine this beautiful custom kitchen, and you end up with a half-tiled floor and a contractor who has vanished.
Which is why I suspect if this model does take off, you'll see a whole secondary industry pop up almost immediately.
Really?
Companies that are shell completion specialists.
Oh, interesting. So they'd offer a fixed price package to finish it for you.
Exactly. They'd probably even partner with the banks.
But wait a minute. Then aren't we right back where we started? I'm just paying a different contractor's markup instead of the developers.
You are. But the key difference is timing. You get to choose when to pay that markup. You can buy the shell now, get your foot on the property ladder, and then save up for 2 or 3 years before you hire that firm.
So you're not actually saving money in the long run. You're buying time.
That's the real benefit. It's about liquidity management, not necessarily total cost reduction. And for a young couple who has the steady income but not the massive down payment, buying time might be the only thing they need.
This whole thing is such a high-stakes gamble. The developer is betting they can offload risk, the buyer is betting they can manage a complex project, and the bank is just trying to figure out who's actually going to pay the final bill.
And the building inspector is standing in the corner just hoping nothing catches fire.
Before we wrap, there's one last thought that's been nagging me. We're framing this as innovation, as democratizing homeownership. But is it really? Or is this just the housing industry admitting that it's broken?
What do you mean by that?
Well, is this just the industry saying that the traditional model, where a professional builds a complete safe home and sells it to a family, is so expensive and inefficient that the only solution left is to pass the hardest, most complex part of the job onto the consumer?
That is a very provocative way to put it. Is this empowerment or is it an abandonment of responsibility?
Exactly. Are we giving people a leg up? Or are we just creating a new, more complicated type of problem and calling it a solution?
Are we democratizing homeownership, or are we, in a sense, just gentrifying the slum upgrading model? It's a heavy question. But if the end result is that people who were completely locked out of the market now hold a set of keys.
Even if those keys open a door to a concrete box.
Maybe that's a compromise worth exploring.
It is definitely a space we have to watch. Different capital has put the shell on the table. Now we just have to see if Jamaica has the appetite and the systems to fill it.
Indeed.
Thank you for unpacking this with me. It's not often a topic combines finance, construction, and deep cultural psychology all in one.
My pleasure. It's always good to dig into the foundations.
And to our listeners, good luck with your property searches or your contractor negotiations. We'll get you on the next deep dive.
Take care.